Understanding Investments a Few Minutes at a Time by Daniel Dower from Chapter 9, Fundamental Analysis, Issue Number 39. Price of Earnings. The P/E ratio, price to earnings, is probably the most commonly cited metric of value for public companies. It represents how many dollars one has to pay today to purchase a dollar of earnings. If the P/E ratio is 20, $1 of earnings costs $20. Naturally, companies for whom the market expects high earnings growth trade at higher P/E. Interestingly, stable, reliable companies also tend to trade at higher P/E ratios. Unfortunately, unless stated otherwise, a P/E ratio is assumed to represent the current price divided by the trailing 12 months of earnings. Earnings, especially in the short term, can be highly manipulated. Restructuring costs, channel stuffing, or obscure tax regulations often distort earnings. For example, in 2012, Microsoft recorded a $6.2 billion impairment charge against their 2011 purchase of Skype. When a company is acquired, the excess price over its book value is recorded as goodwill and annually tested by auditors by present valuing management's expected future earnings. If less than the currently reported goodwill asset, the goodwill is reduced by the difference and recorded as expense. Therefore, the P/E for Microsoft changed from 9 on June 30th, 2010 to 11.5 on June 30th, 2012 to 9.3 on June 30th, 2013. A careful examination of the company via fundamental analysis shows a more stable picture. A number of solutions have been suggested to this problem, and as far back as security analysis, Graham suggested that we instead look at 5 to 10 years of earnings, referred to as PE5 or PE10, the current price divided by the average of the past 10 years of earnings. Such analysis penalizes high growth companies, but that doesn't bother us because high growth gets harder and harder to continue the larger one gets. Later, Robert Shiller coined the term cyclically adjusted price to earnings, or CAPE, using the PE10, arguing that 10 years is required to get a fair impression of how a company fares through a full business cycle. Shiller's numbers are published monthly. Just search for Shiller PE data. I encourage everyone to read more about his work. Examine the data and use it towards getting a rougher idea of whether the market at large seems overpriced or underpriced in comparison to the past. Shiller's data goes back to 1871.